Scott Nations, we talked about the dollar on the air. Let's discuss it again. We're seeing dollar strength. Some people thought that it was already priced in. Do you think the dollar moves significantly higher from here on the fear that more rate hikes are ahead?
I think it is going to get a little momentum, and why is that? It's because, as Jim pointed out on air, that the Fed has managed to hike and the world hasn't fallen apart, and so that indicates that the Fed hiking and the Fed hiking some more in the future is not going to bring the world to an end. We also pay attention to the fact that the Eurozone is doing exactly the opposite thing. They're still trying to lower interest rates, and that's great for the dollar.
Okay, what you said was that we had a rate hike and the market didn't fall apart. Bringing on Peter Schiff in just a moment. He has come on this show multiple times and told us all that the Fed actually would never be able to raise rates. Take a listen.
Everybody is still fooled by the Fed. They still believe that the Fed is serious about raising interest rates as if they can actually do it. Even if the Fed wanted to, they can't, not unless they're willing to put the economy through a protracted recession and a worse financial crisis than 2008, which is exactly what they should do. They should have done it in 2008, but they didn't, so they're not going to do it now. I do think gold can have a nice rally by the end of the year because I don't expect the Fed to raise rates in December.
Peter Schiff is joining us on satellite. Peter, welcome. Your reaction. The Fed did raise rates, and the market isn't collapsing.
Well, first of all, it just happened yesterday, so you got to give it some time. It's not going to happen in one day. But, you know, when the year began, everybody thought the Fed was going to raise rates earlier in the year. People thought March. People thought June. I kept saying the Fed wasn't going to raise. The Fed wasn't going to raise. And then by the end of the year, right, with 2 weeks left in the year, I think the Fed thought they had backed themselves into a corner. Everybody believed that if the Fed didn't raise rates, it would show that they had no confidence in the economy. So I think symbolically, just to kind of show they have confidence in an economy that they should have no confidence in, they raised rates to 25 basis points. And really, I don't even think it's a 25 basis point raise, because if you look at where rates were, the new range is between 25 and 50. If the Fed targets the low end of that range, it might really be 10 or 15 basis points that they're trying to pull off. But I think the rest is back to the bluff. They're not going to raise rates 4 times in 2016, not even close. I mean, we're already almost in a brand new recession, and I don't even think the last recovery was even genuine. But if you look at all the economic data points that have come out, and there was horrible data that was released yesterday that everybody ignored in manufacturing, more horrible data today on our current account deficit, on the Philly Fed. We are rapidly going into recession again. And normally, when the Fed first starts raising interest rates, it's when a recovery is just getting going. So you have a lot of momentum in the economy. You have a lot of pent-up demand. This recovery is already over. And now the Fed is trying to raise rates. They're going to quickly have to reverse course next year. They're going to take rates into negative territory, not just real rates, but nominal rates. And they're going to do QE4, and it's going to be bigger than ever.
Wow. Peter, you're talking a lot of big talk here. The first piece of it, the word recession. When do you think that happens, triggered by this rate hike?
Well, you know, remember, the Great Recession started in December of 2007. Mid-2008, the Federal Reserve still didn't have a recession in its forecast, even though we were knee-deep in it. I remember going on television shows in early to mid-2008 talking about how weak the economy was, and nobody believed me. So I think the economy could already be there. Certainly if the government measured it honestly, it is. But I think we can have a very weak GDP number in the fourth quarter. In the first quarter, we can easily have a negative number. You know, the Christmas sales are going to be horrible. It's already off probably to the worst Christmas season since 2008, 2009. Businesses are loaded up on inventories, and they're also loaded up on employees that they don't need. So I think a lot of layoffs are coming early in the new year. I've been saying this for some time, and I think I'm going to be vindicated. And so Janet Yellen is theoretically raising interest rates just as unemployment has hit its lows, and now it's going to be moving up.
Okay, so I just want to follow along with your school of thought here. If that's the case that you just described, is that what triggers the Fed to come back in, reverse course, as you're suggesting, and take us into negative territory?
Yeah, I think when the layoffs start and we start to see some negative non-farm payroll prints, meanwhile, manufacturing is already in a recession, and that's just going to get worse. And obviously, this rate hike and the belief that the Fed has got more coming is just going to accelerate this process. You know, you don't find out about all the mistakes that were made until the Fed tries to remove the stimulus. We have had 7 years of 0% interest rates, and the damage that the Fed has done to this economy is immense. It's much greater than what was done under Alan Greenspan, and that gave us the 2008 financial crisis. So you can only imagine what lies ahead as a result of what the Federal Reserve has done to us this time.
Peter, what if you're wrong? What if the Fed's confidence in the economy has a grain of truth to it? What if this recession doesn't happen and we do see maybe not 4 rate hikes next year, but a gradual plan as the Fed has suggested?
Well, I suppose that I could be wrong about it, but I don't think so. I mean, look at Ben Bernanke, rather.
But you also
I just
said
saw
she
him
would never
interviewed
raise,
or listened to an
and she
interview with
did.
him in which he was asked about all the rosy statements that he made in 2005 and 2006. And then he tried to cover his tracks by admitting that he was speaking as a member of the administration. And I think Janet Yellen is doing the same thing. She is a loyal member of the Obama administration, and she wants to talk up this economy. She wants to pretend that it's a strong economy, that she has confidence. If she had confidence, she would have raised interest rates years ago. In fact, all the economic data was much stronger years ago than it is today. So if that was the case, why didn't they raise interest rates a long time ago? Why wait until the data is at its weakest in 6 years and then, claiming to be data dependent, raise interest rates anyway? This is all to try to pretend the economy is much stronger than it is. But all of this is going to come back to haunt the Fed in 2016 when they have to deal with the consequences of this. And I think they're going to look a lot more foolish having raised rates and then having to reduce them than had they left them at zero the whole time. But of course, all of this is wrong monetary policy. Interest rates need to go up. They need to go a lot higher. And it shouldn't be the Fed that decides that. It should be the market. But once this bubble economy has to deal with a market rate of interest, the whole thing is going to implode because we've never had a recovery. We've just had a bubble.
Peter, you certainly are entitled to your opinion, and you've laid out the scenario that you think is going to occur. But why can't you just admit that, as we showed in the clip, you said the Fed could never raise rates, and the Fed did?
Yeah.
You were wrong.
Yeah, so other people thought they would raise rates a lot more than just a quarter point for all of 2018. Look, I knew it was possible that they could do it, and this is only, again, 25 basis points. And the only reason they did it was because they were afraid not to, because people were going to say that this must mean that they're nervous about the economy. So to show that they weren't nervous, they raised interest rates even though they didn't want to do it, and even though they are nervous. But I don't think this nullifies what I've been saying. And ultimately, if they have to go back to zero, if they have to go negative, if they have to launch QE4, then that validates everything I was saying. And this symbolic rate hike isn't going to mean anything.
Scott Nations.
Peter, for a long time, you've been quite a bull in gold. It's down 25 bucks today. It's at its lowest level in years. What do you say to the people who bought it at $1,700 when you said buy it there? What do you say to the people who, again, bought it at $12.25 when you told them to buy it there? What do you tell them when it's now at $10.50?
Yeah, well, the same thing I've been telling people all along. Remember, I started telling people to buy gold when it was under $300 an ounce. So depending on when you first started listening to me, that depends on, on where your situation is. But I don't tell people to put all their money in gold. I tell people to put some of their money in gold, 5 to 10%. And as you get more money, and if the price of gold comes down, now you can add to it at a better price. I mean, I think my advice to have some of your money in gold is much better than almost everybody else's advice in this industry, which is to have none of your money in gold. And, you could look at history over the last 15 years. The stock market has been cut in half twice. And there are plenty of stocks that people have bought that were highly touted on your network that went down a lot more than the price of gold has gone down from its peak. So it's not
Peter,
that an asset can't go down, especially when so many people are so wrong about what they're perceiving. Remember, in the short run, right, markets are a voting machine. In the long run, it's a weighing machine.
Peter, let's
and
talk
right
about,
now, the votes
talk
that
about
everything
being
is
so
great
wrong.
and that the Fed is doing everything right outnumber the votes of the people who know that they've done everything wrong. But in the long run, the
Peter,
price
let's
of
talk
gold is
about
going to
being
reflect
so wrong.
all these mistakes.
Peter, you're doing a great job of filibustering, but let's talk about being so wrong, because when you told people to buy it at $1,700, you said it was on its way to $5,000. That sounds like so wrong to me.
So,
and the problem I've often had with what you said
Scott.
is you make 100 outlandish predictions. 99 of them are wrong.
No, I don't.
One of them sort of
No,
comes
I don't.
right.
And most
comes
of my
out
predictions,
right.
I've made a lot
Hey, Peter,
more
I let you
accurate
finish. Let
predictions
me
than you have.
finish.
But
Peter,
Scott,
I
let
let
me
you
ask you this.
finish. I let
Have
you
you-
talk.
Scott.
Let me finish. The problem is, Peter, that everybody that listens to you has lost all their money when they followed you with the first 99 predictions that were wrong, and when one sort of comes back around, they're broke. And the problem is that even when you're wrong, because you said that the Fed couldn't raise rates, wouldn't raise rates, and QE4 would be next, you can't, you're not admitting that you're wrong. And the worst decision that anybody can make when they're investing or trading is to not admit when they're wrong. That's how you get carried out.
Have you ever told somebody to buy a stock at 19 and it went to 17? Has that ever happened to you?
Peter, that's not what you did. You told people to buy it at 1,700 because it was going to 5,000, and it's now at 10.50 down 20.
You know what?
Now
but
down
it's
$26 on the day.
Scott, it's still going to go there. You know, so you've never bought a stock that went down before it went up. Everything that you buy goes up immediately and never goes down. Excuse me?
So, Peter, you're never wrong. You weren't wrong when you said that QE4 was going to come before an interest rate increase.
Wait a minute, Scott,
this is why I think you're dangerous, because you're not willing to admit when you're wrong. Traders and investors are wrong all day, every day.
Guys,
there you go. See, that's the problem.
If I could just jump in for a moment.
You didn't predict QE 1, 2, or 3 either. Why don't you give me credit for that?
Peter, with a final question to you about gold prices that kind of wraps up this conversation that you're having. You're still taking the view that gold is going higher. As you mentioned, you're relating it to stocks that potentially they go down before they go up. How much lower do you think we could go before we start to rise again?
Well, again, I don't know. I don't think there's that much downside because I think most of this is already built into the price. Everybody has been anticipating the Fed was going to raise rates. In fact, they thought they would have raised them a lot more than 25 basis points by now. There are still people who think there's a lot more rate hikes coming. I still believe that's wrong. People are ignoring the inherent weakness in the U.S. economy and the fact that the Fed is going to be back to its old tricks. It only has one game plan for recession, and that's printing money. And when rates are at 25 basis points, there's not a lot of room to take them lower. You can go negative, but it's QE4 that they're going to be relying on. In fact, Janet Yellen said so herself in a press conference a couple of weeks ago. She was asked, what are you going to do if there was a recession in 2016? And her response was more quantitative easing because it worked so well last time. Well, it didn't work well last time. That's why we're going to be right back in recession in 2016.
Peter, we got to run. Just to recap your points there, you do think that we're going to see a recession that's going to trigger the Fed to take back the action with the rate hike, maybe take us into negative territory, and that QE4 could be on the table. We're going to hold you to these predictions. We always do. We'll have you back on soon.
Absolutely hold me to it.